Hey there, Iggy the Investing Iguana here. In this video, we'll dive into the exciting news of Frasers Centrepoint Trust, or FCT, joining the Straits Times Index, STI, in March 2024. As the Heartland Malls King, FCT's inclusion in the STI is a big deal for investors. Stick around as I break down what this means for the REIT and why it's worth keeping an eye on. Trust me, you don't want to miss out on this valuable information that could help you make smarter investment decisions. First off, let me explain what the STI is. It's basically the top 30 companies listed on the Singapore Exchange, ranked by market capitalization. The STI, or Straits Times Index, is a significant indicator in the financial world, particularly in Singapore. It represents the performance of the top 30 companies listed on the Singapore Exchange. These companies are not chosen randomly, but are ranked based on their market capitalization. Market capitalization is a simple concept. It's the total market value of a company's outstanding shares of stock. It's calculated by multiplying a company's shares outstanding by the current market price of one share. This gives us a monetary value of a company, indicating its size and investment desirability. When a company like Frasers Centrepoint Trust, FCT, gets added to the STI, it's a momentous occasion. It signifies that FCT has grown to become one of the largest and most influential players in the market. This not only brings prestige, but also tends to increase the company's visibility among investors. Being part of the STI means that the company's performance will directly impact the index. If FCT does well, the STI is likely to rise. Conversely, if FCT's performance falters, it could negatively affect the STI. Therefore, being added to the STI is not just an honor, it's also a responsibility. The company is now in a position to influence one of the key benchmarks of Singapore's economy. Frasers Centrepoint Trust, FCT, has earned the moniker King of Heartland Malls due to its extensive portfolio of 9 suburban retail malls and an office building in Singapore. These aren't just any malls, they're strategically located near Housing Development Board, HDB, areas, which are home to a significant portion of Singapore's resident population. This strategic location ensures a steady stream of foot traffic from locals who frequent these malls for their daily necessities. From groceries and household items to dining and entertainment options, these malls serve as one-stop destinations catering to a wide range of needs. This is a significant advantage, especially during economic downturns when spending patterns shift. During such periods, people tend to prioritize essential purchases over luxury goods or discretionary spending. As FCT's malls are primarily focused on providing these essentials, they are somewhat insulated from the fluctuations of the economy. This is in contrast to malls that rely heavily on tourists and expatriates, who might cut back on their spending or might not be in the country at all during economic downturns. Moreover, the Heartland Malls, as they're often called, are more than just shopping destinations. They are community hubs where people gather, socialize, and participate in community events. This fosters a sense of community and belonging among the residents, further driving footfall to the malls. Another thing I like about FCT is their strong operating metrics. As of December 2023, their malls boasted an occupancy rate of 99.9%. This figure is remarkable as it essentially means that almost all available retail space within their malls is being utilized. This high occupancy rate is a testament to the attractiveness of FCT's malls to retailers and businesses. It indicates that these entities see value in setting up their operations in these malls, likely due to the steady footfall and the mall's strategic locations. In addition to the high occupancy rate, FCT has also seen improvements in shopper traffic and tenant sales. Shopper traffic refers to the number of people visiting the malls. An increase in this metric is a positive sign as it means more potential customers for the tenants, which could lead to higher sales. On the other hand, tenant sales refer to the revenue generated by the businesses operating in the malls. An upward trend in tenant sales is beneficial for both the tenants and FCT. For the tenants, it means their businesses are doing well, which could lead to business expansion and job creation. For FCT, higher tenant sales could lead to higher rental income, as rental rates could be adjusted based on the sales performance of the tenants. These strong operating metrics are indicative of the robustness of FCT's business model. They reflect the trust and confidence that both tenants and shoppers have in FCT's malls. This bodes well for FCT's future prospects, as it shows that they are capable of delivering value to both their tenants and the end consumers. On the financial side, FCT's debt metrics look healthy too. They have a moderate gearing ratio of 37.2% and a decent interest cover. The gearing ratio is a measure that compares a company's total debt to its total shareholder equity. It's a useful tool for understanding the financial leverage of a company and the level of risk it might be exposed to. A ratio of 37.2% suggests that FCT has a balanced approach to financing its operations, using a mix of debt and equity. Another positive sign is FCT's decent interest cover. The interest cover, or interest coverage ratio, is a measure of a company's ability to meet its interest payments on outstanding debt. A higher ratio is generally better, as it indicates that the company is well positioned to meet its debt obligations even if its earnings were to decline. Perhaps the most reassuring aspect of FCT's financial health is the absence of any debt refinancing needs in 2024. Debt refinancing involves replacing an existing debt with a new one under different terms. The fact that FCT doesn't need to refinance any debt in the near future gives it financial flexibility. It means that the company can focus its resources on other areas, such as investing in new projects or improving its existing assets. Frasers Centrepoint Trust, FCT, is certainly not resting on its past successes. The company has recently announced plans to acquire an additional 24.5% stake in NEX, the largest suburban mall in northeast Singapore. This acquisition is a strategic move that will further strengthen FCT's presence in the retail sector. NEX is not just any mall. It's a gem in the retail landscape of Singapore. Its strategic location, connected to two mass rapid transit (MRT) lines, makes it easily accessible to a large number of people. This accessibility, coupled with a wide range of retail and dining options, attracts over 36 million shoppers a year. By increasing its stake in NEX, FCT is positioning itself to benefit from this high footfall and the resulting retail sales. But FCT's strategic moves don't stop there. The company is also investing in the renovation of Tampines 1 Mall. This major facelift is aimed at keeping the mall fresh and exciting for shoppers. Renovations can include anything from aesthetic upgrades to the addition of new stores or amenities. By continually updating and improving its properties, FCT ensures that its malls remain attractive to both tenants and shoppers. In conclusion, Frasers Centrepoint Trust, FCT, presents itself as a compelling investment opportunity for those seeking stable returns. One of the key strengths of FCT is its consistent dividend payments. Dividends are a portion of a company's earnings that are distributed to shareholders, and consistent dividends are often seen as a sign of a company's financial health and stability. FCT's business model, which focuses on necessity spending and essential services, further enhances its resilience. This means that the malls owned by FCT cater to the everyday needs of consumers, such as groceries and household items. This kind of spending tends to remain stable even during economic downturns, providing a steady stream of revenue for FCT. While FCT's dividend yield may not be the highest among real estate investment trusts, REITs, it's important to consider the overall picture. The dividend yield is just one aspect of an investment. FCT's stability, demonstrated by its consistent dividends and resilient business model, combined with its growth potential, evidenced by its strategic acquisitions and renovations, make it an attractive investment. However, like any investment, investing in FCT comes with its own set of risks. Economic conditions in Singapore could deteriorate, which could impact FCT's portfolio. A downturn in the economy could lead to a decrease in consumer spending, which could affect the revenues of the tenants in FCT's malls, and in turn, affect FCT's rental income. But it's worth noting that the defensive nature of suburban malls, like those owned by FCT, helps mitigate this risk. These malls are located in residential areas and cater to the daily needs of residents. This means that even in an economic downturn, people will still need to buy groceries and other essentials, so these malls are likely to continue to see foot traffic. To sum it up, Frasers Centrepoint Trust's entry into the STI is a testament to its strong fundamentals, resilient portfolio, and growth potential. As the Heartland Malls King, FCT offers stability and consistent returns, making it an attractive option for investors looking to diversify their portfolios with a defensive retail REIT. Remember, investing always comes with risks, so be sure to do your own research and consider your risk appetite before making any investment decisions. If you found this video helpful, don't forget to smash that like button and subscribe to the Investing Iguana channel for more insights on REITs, stocks, and all things investing. Stay savvy, my friends, and I'll see you in the next video.